Today we're going to be discussing the deferred tax balance calculation and then also the calculation of the movement between the opening and closing deferred tax balances, which is expected to give me my deferred tax expense calculation. Now, I'm going to ask you please to always start with your deferred tax calculations and the deferred tax movements from the statement of financial position approach, the deferred tax balance calculation. Yes, we can calculate it, a part of that movement from the current tax comp, but rather use that as a proof unless the question really doesn't have sufficient information for you. So today's lecture is going to be purely on how do we lay out the format and what are the principles here. So for the deferred tax balance calculation, you're going to have the following headings: the carrying amount, which is your accounting figure, your balance per your financial records; the tax base, which in terms of our earlier lectures we've discussed, the tax base of an asset will equal future tax deductions. The tax base of a liability will equal carrying amount minus those future tax deductions. And the tax base of income received in advance will equal the carrying amount minus the income not taxable in the future. So just assuming we're dealing with assets here, the carrying amount of an asset, let's say an item of PPE, let's say that that's 1,000 Rand. That represents the future economic benefits that are part of the asset that's on the statement of financial position. The tax base here, for instance, may very well be 900, and that represents the future tax deductions. So carrying amount of 1,000 minus the tax base of 900, future income carrying amount minus future tax deductions, tax base, gives me the temporary difference, and in this scenario that 100 Rand temporary difference is going to be a taxable income in the future. That will give rise to a future outflow of deferred tax, or future outflow to the tax authority. Today we will recognize that as deferred tax. Let's assume 30%, so that would give me a 30 liability, a future tax payment with a present obligation today. And yes, we might have a provision there as well, and that provision would give me a carrying amount. I'm using some simple numbers from maths. Let's say I have a carrying amount of 1,000. The tax base there would be the carrying amount minus future tax deductions, which is going to be 0 as discussed in earlier lectures. The temporary difference there would be a future tax deduction of 1,000, and that would give rise to a 300 deferred tax asset. Now let's just have one more in here. Let's work on a prepaid expense. A prepaid expense, obviously there, the accounting treatment is going to differ from the timing of the deduction for tax purposes. So again, let's have 1,000 prepaid expense. Now the tax base would be future tax deductions. That's going to equal 0 here because, well, the tax authority has already given you the deduction when you made the payment. So the temporary difference of 1,000 would be a future taxable income, and that would give me a 300 liability. So I'd add those up, and let's maybe mark off taxable temporary differences as a T, deductible temporary differences as a D. That would give me a total net taxable temporary difference of 100 and a deferred tax liability balance of 30. And that is what we're going to call the deferred tax balance from the normal temporary differences. Normal temporary differences, items with a carrying amount on your books that will have different timing of incomes and deductions for tax purposes. So what else could happen on this calculation? I might very well have my assessed losses. So I'm going to put that in a different color. And the assessed loss in the current year, well, we know that that is definitely not a accounting figure. That purely is a tax figure, and let's continue to use 1,000. Let's say I have a future tax deduction of 1,000. Temporary difference being a deductible temporary difference of 1,000 would give rise to a deferred tax asset of 300. But here we would probably have a bit of a problem in the fact that that assessed loss would not necessarily be recognized in the future. We will have a future a discussion about the assessed losses and how you need to assess the recoverability thereon. But basically, the basic scenario here is that if there's no other indication of future taxable income to utilize this assessed loss of 1,000 in the future, well, then we're going to have to only raise the tax asset to the extent that we will have future taxable income. So what does this 1,000 represent? Well, sorry, the 100 taxable temporary difference represent? Well, that 100 represents future taxable income. And what I'm saying is that this assessed loss is saying that we will be able to have a future tax deduction of 1,000. But if there's only future taxable income of 100, you will only be able to recognize 100 of the 1,000 future tax deduction from the assessed loss. So I would need to de-recognize or unrecognize 900 of that assessed loss, which would mean I would only raise a taxable or deductible temporary difference of 100 Rand, and therefore only a deferred tax asset of 30. I would need to unrecognize the other 270 of this deferred tax asset, and that would then give me a total deferred tax balance of 0 with temporary differences of 0. So let's say that that now is going to be my closing balance. The closing balance of my deferred tax. Now we would also need to do a similar or exact type of calculation for the prior period. So the prior period, let's call that the opening balance calculation. Opening balance, again, carrying amount, tax base, temporary difference, and deferred tax. Let's assume for now that we're going to stick to 30%. And let's say prior year's deferred tax balance was as follows. We had an item of PPE with a carrying amount of 1,000. A tax base of, let's actually make this a little bit more interesting, a carrying amount of 2,000, and last year the tax basis was 1,000. Therefore, future taxable income would be 1,000, and that would be a taxable temporary difference. That would give rise to a deferred tax liability of 300. Let's assume that that was the only deferred tax in the prior period. Therefore, in the current year, I would now need to do a movement calculation. And that movement calculation would be as follows. I would first need to work out my total deferred tax movement. And I'll split that up into my temporary differences normal and my assessed loss. So my opening balance, my total deferred tax liability was 300, and that was all due to normal temporary differences. The assessed loss was 0. What we needed to get to, however, was a closing balance, and the closing balance per the previous schedule, well, the total was made up of 0 being a 30 deferred tax asset from the assessed loss and a 30 deferred tax liability from normal temporary differences. So the closing balance of 0 made up of a 30 deferred tax liability and a 30 deferred tax asset from the assessed loss. So the movement now, the movement from 300 to 0, well, that is going to be a deduction, a reduction of the liability being a debit, an asset movement. The total temporary difference movement will go from 300 liability to 30 liability, which would be a 270 deduction or reduction of the liability, giving me an asset movement, a debit financial position. And the assessed loss is going from 0 to 30 asset, would also be a 30 asset movement. How would that be journalized? I would do this in two separate journals. I would have done my assessed loss based on my current tax computation, and I would have gone debit deferred tax, financial position, credit deferred tax, profit and loss, with a net 30. I'm going to discuss that journal in a bit more detail in a few seconds. But the temporary difference normal has gone from 300 to 30, being a debit deferred tax financial position to make the liability smaller by 270, and we would credit, let's assume all the underlying temporary differences went through profit and loss. So therefore the deferred tax will go through profit and loss. I just want to discuss one thing more in detail for this video, and that is the breakdown of this assessed loss journal. Now, the way I've written it there is the common fault that most people in practice as well as exam writers will make. So what we need to understand is this deferred tax journal is actually made up of two components. There would have, first of all, if you recall from the previous slide, there was a total from the current tax comp. So I'm going to draw a little replica of the current tax comp on the left-hand side here. The current tax computation had the following: profit before tax of whatever that may be. And then there would be the permanent differences, movements in temporary differences, and we'll go all the way down, and there was a big tax loss. And that tax loss, we know how much that was. That was given to you as 1,000 tax loss. And you got to carry that forward, so you would have your assessed loss current year carried forward. I would add that 1,000 back to get to taxable income, excuse my abbreviation, space is a bit tight, of 0. So the journal that I would first pass from that 1,000 is debit deferred tax, financial position, credit deferred tax, profit and loss. So we're assuming a 30% tax rate here, and that would have given me deferred tax asset of 300. Now that's journal you pass irrespective of whether there's an unrecognized tax loss or not. On the previous slide, that would be the 300 deferred tax asset that's already sitting there. But in our little working here, we had to take out or unrecognize 270 Rand worth of that deferred tax asset because there was no convincing evidence of future taxable income. Therefore, I would have a separate journal for that. And that second journal would be debit deferred tax, profit and loss, credit deferred tax, financial position, and I would derecognize 270 Rand of that deferred tax asset. So please take note. My working on top there is perfectly sound from the end product result. Debit deferred tax, financial position 30. But that is made up of the original deferred tax on the assessed loss of 300 minus the unrecognized portion of 270. So that's how we'll get to our total deferred tax balance as well as the tax expense movement between the opening balance and closing balance. Please stay with me now. I'm going to be doing videos on some more basic principles, but now applying them to some real life scenarios. Thank you.